AMC is down, cryptos are down, and the stock market are all down substantially, guys. We need to talk about what is going on here, what are the main factors that are leading to this decline today, as well as how you guys can potentially make a ton of money through a crash or correction if that does happen, as well as give you guys my opinions on what is going on. So with all of that being said, we have a lot to unpack in this video, so I don't want to waste any time getting into it. The only thing that I ask is that you hit that like button and subscribe to the channel to push this video out to even more people, as well as comment down below how big do you think a correction could possibly be, as well as what do you think will be the tipping point, and what do you think out of this whole video is the biggest factor that is leading to this sell-off. Now, the Dow Jones is down 1.22%, the S&P is flirting with down about 1%, the Nasdaq down 0.70%. So tech is definitely doing the best today. Now, it looks like the biggest reason we are selling off in the stock market so hard, cryptos, and even stocks like AMC, is because the St. Louis Fed President James Bullard told CNBC he sees an initial interest rate increase happening in 2022 as inflation picks up. He says that's even faster than the consensus estimation for the first increase to happen in 2023. He said, in quotes, "You love to have an economy growing as fast as this one. You love to have a labor market improving the way this one has improved," he said of current situations. And then he goes on to say, Bullard, as several points, describes the Fed's moves this week as, in quotes, hawkish or in favor of tighter monetary policy than what has prevailed since the onset of the COVID-19 pandemic. He said, in quotes, "We're expecting a good year, a good reopening, but this is a bigger year than we were expecting, more inflation than we were expecting," the central bank official said on Squawk Box. "I think it's natural that we've lifted a little bit more hawkish here to contain inflationary pressures," and then does go on to say that he sees inflation running at 3% this year and 2.5% in 2022 before drifting back down to the Fed's 2% target. Now, there's something very, very important that we do have to talk about, and the Fed, for the first time, has done something to try to restrict some of the money that is flowing in our economy right now. And what they did, we will get into in 1 second, but it is called interest on required reserve balances and excess balances, or just abbreviated IOER. And this is essentially where all these banks, they have reserve requirements they have to hold depending how much money they're supposed to have on their balance sheet. Obviously, if you go to the bank and try to demand $1 billion, they're not going to have it right there. It is tied up with other investments, but they do have to have a certain amount of cash on hand in their reserves to meet any major requirements, right? So we don't have a Great Depression type moment again where banks don't have enough money to pay people out if they wanted to get their money out. Now, essentially what happens, because it is a liability for banks to hold all this cash in reserves and not make a lot of money on it. So the Fed actually pays them interest for the money they keep in their reserves. And this change did happen on Wednesday and is effective June 17th, where essentially they took this rate during the whole pandemic from 0.05% up to 0.15%. That incentivizes banks to keep more money in the banks and to restrict some of that money going back into the economy. So the news, the media really hasn't picked up on this, but this is something that they have been doing, or at least just started to do, to try to restrict some of the cash that is flowing in the economy right now. So that is something to keep in mind. And even though the news media really hasn't reported on this, I do think this does have some investors spooked, and does make a lot of investors think that we will see bond tapering. That is where they purchase about $120 billion worth of bonds. Keep in mind, the bond market is about 9 times bigger than the stock market. They have been purchasing these bonds, so a lot of investors do think they will start pulling the rug on this and start backing down on some of their payments. Obviously not all of them, but start going down to 100 billion or 80 billion a month, and that would definitely have an impact on the stability of the markets, as well as an eventual rate hike increase, or an interest rate hike increase. So that is something very, very significant to keep in mind during all of this, and that is just, like I said, a big signifier that some people are thinking that they're going to start tapering, even possibly during their next meeting or in the following meeting after that in about 3 to 6 months. So that is something to keep in mind. But I also do want to point out the fact that it is quadruple witching today. This only happens 4 days out of the year. All 4 asset classes expire simultaneously on the 3rd Friday of March, June, September, and December. It says quadruple witching refers to a date on which derivatives of stock index futures, stock index options, stock options, and single stock futures expire simultaneously. While it may result in increased volume and arbitrage opportunities, quadruple witching does not necessarily translate to increased volatility in the markets. Quadruple witching days witness heavy trading volume in part due to the offset of existing futures and options contracts that are profitable. So you're going to see a lot of liquidity coming out of these contracts, these futures, and start to go back into the markets. Now, this can either have a very good impact or a very bad impact, but due to the facts we have already talked about in this video, I do think a lot of people probably lost money on these contracts that did expire. Now, something else I want to point out as well is we're at our highest margin levels we have ever been at. We are currently at, for the month of May, $861 billion in margin debt. Keep in mind, most of this is held by hedge funds and institutions. Some of this obviously held by banks, but it is definitely, for the majority of over leveraged individuals and hedge funds, that are the main driving sources of all of this margin debt. Now, with all of the short squeezes we have been seeing, with AMC running up and going crazy, a lot of this margin debt is actually negative on these positions, because we have seen a ton of money being lost during these short squeeze events, especially in AMC, GameStop, a lot of these other stocks that we all know about, right? We know what has been going on with these stocks. So I do think a lot of people are having to at least try to drive down the share price, probably fraudulently by Citadel and all these other people, to try to cover their shorts at a cheaper cost. But we are going to see a lot of these hedge funds and institutions start to sell some of their stocks in other winning stocks, right? Peloton, Neo, all these other stocks that have been doing good, take some of that money out to make sure they can stay in these short positions or try to cover their short positions. And I do think you are seeing this right now, and that is what is going on, in my honest opinion. But even if you take a look at the S&P 500, like I said, we're currently down 0.92% for the day, so that is a significant drop, but we are overdue, long overdue, for a correction of some sorts. And a lot of this actual market increase, right, the price increase of the SPY and a lot of these other stocks, is artificially increased. Now, PE ratios for stocks are also almost at their all-time highs, being at about 38% price to earnings ratio. So that is another factor, as well as just the overall trend here that the S&P 500 is due for a correction. So I think when you add all of these factors together, it does give you an indication on that we should see a correction or potentially a crash in the next couple of days or weeks or months. Now, getting into how you guys can actually trade this and make a ton of money on this. Now, there's a lot of possible ways to do this. You could play the UVXY, which basically tracks the number of calls to puts. If the market goes down, the UVXY goes up. And I do have a trade on this from a while ago that I'm actually down on. So I'm not going to pay too much mind to that, but that is something you guys can do. As you can see, we're down about 1% on the markets. This thing is up 8.80%. So when you see really bad down days, people are flocking to puts, you could definitely buy calls in this and make a lot of money. That is kind of expensive though. What I have been doing and what I like to do right now is buy debit spreads on the S&P 500. Now, I did this a couple days ago. I believe I did this on June 16th, right when the Fed meeting was happening. I bought these debit spreads, and it's essentially you're buying a 411 put and you're selling a $410 put. So for each contract that you do, you have a max gain of $100, the difference between $411 and $410. I bought these for 10 cents. They're currently up 90%. If you guys want to be up on these trades, hit that link down below for the buy and sell alerts. But anyways, I'm up about 90%, but this is a way you can get into a trade like this with minimal costs and have a huge potential upside. Where I got in at $10, and every single one of these contracts could potentially be worth $100 if the SPY closes under $410 by next Friday. So if this happens, you would automatically automatically make $100 per contract. You bought them for $10. That would be an automatic gain of 1,000% on your investment, taking $50 to $500 instead of actually buying the premium, because the premium is pretty high, especially if you want to get closer to the money like I did want to do. Now, I did buy the 410 and 4, well, I bought the 411 puts, sold the 410 puts, but these would cost you about $200, and it's no telling how high they could go. So it is better, in my opinion, to just do a debit spread that is closer to the money, so you can play these trades with a minimal cost. You're not putting $200 up, but you could still potentially gain 1,000%. Like I said, you're close to the money. These 411s are only about $5 out the money, so I do think odds are definitely in our favor that these will actually or the SPY will close under $410 by next Friday, especially the way these are going. And for you to make this 1,000% gain, you only need the S&P 500 to drop 2%. So if you see a really bad day next week, or just a couple bad days, right, you're gonna close under this $410 price. So this is a very cheap way you can play these kind of trades. Now, I actually did get some other ones today as well. I will just go back to the overall portfolio to show you guys this, because it's a lot easier to do in the one trade instead of having a whole bunch of trades everywhere. Now, I did go a further bit out on these ones. I did grab a July 16th SPY. I bought the $396 puts, sold the $395 puts. So obviously that is a max gain of $100 per contract if the S&P closes under $395 by this expiration date, which is July 16th. But I paid $12 for these contracts. I got 5 of them. So you're essentially just like the other trade. Your max gain would be almost 1,000% on this trade. You spent $600. Your max gain is $500. Like I said, if the S&P 500 closes under $395 by this expiration date, which is July 16th. So I do think if we're going to see a major drop, it will be before July 16th. I could be wrong on that. I could be right on this. This is just a little bit of hedge to protect my overall portfolio in case we did see that huge crash or correction. Then you would at least make some money from the downturn. But it's always not a bad idea to just buy the premium outright if that is something you did want to do. Now, there's other ways you can actually do this. You could buy puts on a lot of major stocks, right? The Dow has been down even worse, so I would probably go with some Dow stocks. Tech stocks have actually been doing a little bit better today. Something else you guys can buy as well that does invert the market. So when the market is down, this is up, and it is called the daily S&P 500 Bear 3X leverage. And you just have to be careful with this, because if the markets are down a lot, this is going to be up a lot. If they're up a lot, this is going to be down a lot. So you have to know what kind of risk you are taking here, but this does tend to be a little bit cheaper than some of the other options. Now, as always, I would like to get more time, but you could even do debit spreads on these, and that would obviously limit your max potential gain, but it is really cheap. But even to go out, some of these contracts are in the $20 range. If you did see a major correction, these would make you a ton of money, but this is not a recommendation. This is only showing you guys some ways that you could profit off a crash or correction, and even get insanely rich if you do time it right. Now, I would never tell you guys to put a lot of money into these trades. They're really just a hedge for your overall market, because if you can hit some of these naked puts that you have, right, you're not debit spreading them, but if you have naked puts or calls in the case of inverted ETFs, then you could make a lot of money. You could turn $40 into $10,000 or $20,000 if you did time a crash or correction perfectly. Now, it's not always going to happen like that. That's why I say that you should not put a lot of money into these trades, because odds are you will lose money on these trades, but it's almost worth throwing $50, $100 at these trades in case something did happen. Now, with that being said, that is going to wrap up this video. That is why the stock market is falling so hard. Pretty much ties into crypto, AMC, everything else. This is the main driving factors as to what is going on here. We're seeing mass liquidations. We are seeing the Fed come out and saying inflation is running rampant, that we could see tapering and even rate hike increases sooner than we all do expect. So that does have some investors pretty spooked. Let me know down below in the comment section what you think about this information, as well as if you like this video, make sure to hit that like button as well as subscribe to the channel. I do greatly appreciate every single one of you guys. Check out the links down below to get up to $70 in whatever free stock that you want using the link for public. I got $30 worth of Beyond Meat and $50 worth of Tesla for absolutely free. No need to link a bank account or deposit a single dollar. You might as well roll the dice and see what you do get. It's literally free money. Also, check out the link down below for the buy and sell alerts to be notified every single time a trade is being bought or sold, as well as be a part of a great community that sources great information and trades all day long. With that being said, I will see you guys later. Take care.